Hey, what's up, guys? Justin here with Confident Options. Today is Sunday, October 7th. We've made it through our first full week of October. Hope you guys had a fantastic week. We did. We'll go through the 5 trades that we had from last week, which was 10-1 through 10-5. We actually had 5 closing trades. We'll start down here at the bottom, and all 5 were winners. So, solid week for us, and we were able to put a lot of good positions on near the end of the week when the market started selling off. So we'll see what happens with that, but we'll go through what we have here today. So first was a strangle in deer, ticker symbol DE. No adjustments, no rolls, simply held the position. It moved around quite a bit on us, but that's what's to be expected when you're entering stocks with high IVR. Next up was Pepsi, was an earnings strangle. As a side note, we're starting to throw in IV rank because that's a big part of what we do. So I want you guys to be able to see, when you enter and exit the trade, what IVs are we looking at and focusing on when that happens. So in this case, we had an IV rank, which was pretty low considering for earnings, which was only 33 on the open, and then it crushed down to 23 overnight. So, it's a solid move in IV. The problem is this wasn't elevated enough to be able to really capture a lot of premium, and it also was a pretty expensive trade. So you need a pretty good size account to take on the trade, but ended up being a small winner for us, so we'll take it and move on. That was our only earnings trade of the week. Nice long trade here in Tesla. We're going to go over this one in more detail. It was an iron condor. It ended up being a winner for us. Canopy Growth, one of the pot stocks that's been flying lately. We jumped into the trade when the thing was at 93% IV. I'm calling this IV rank. The problem is that it doesn't have an IV rank because it's a new stock. It's not a new stock. I think it's a new stock, but it doesn't have a rank because I don't think it's been around long enough. So we're using the pure IV, which was 93 in this case. And then on the trade close, it crushed down to 77. So a good, nice contraction in IV throughout the trade. And it ended up being a nice winner. When you get into these high IV trades, you're going to get tested. It's going to move a lot. That's the whole point behind implied volatility, means that there's a lot more movement in the stock. So just be prepared when you're trading these high IV trades. And last trade, which we'll also go through in more detail, was a strangle in Tesla. This actually ended up being one of our largest winners of the year. Started out at 92 IV rank and came down to 77 by the time we closed off the trade. Like I said, this is one of our largest winners of the year with just one contract. You could have made $700. Sorry, I'm not sure why that's so big. $700, and then for 2 contracts, $1,400. So really good return on capital. It takes a bit bigger account to trade such a large underlying with such high IV. So just keep that in mind. You could have made it an iron contour like we did below, but with IV so high on the entrance, all signs were pointing to strangle when it comes to IV rank that high. So let's jump right into it. We're going to go through the first Tesla trade that we had, which was this long one, which had 4 adjustments and 2 rolls. Started out actually in September. We took September, rolled it to October, and then we rolled October to November, all the while collecting credits along the way. So we'll go through in more detail over on the charts. Pull up Tesla. And I went ahead and used some arrows to mark our entries, rolls, and so that way it gives it a little bit more visual as we walk through the charts. But you can see a chart of Tesla. It's been an excellent vehicle over the year. Just by looking at the line on my screen, if I put it right here, it touched that line 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, like 14 or 15 times throughout the year, meaning that there's awesome two-sided action. It's not just going up, going down. This has been a fantastic vehicle for us, and we've had times in the year where the IV's just been through the roof, which are opportunities. So you need to remain opportunistic when this stock hits highs like this in IV. It's a good opportunity to trade, and so you can't back down. You can't be shy. You got to just put your capital to work and get in these trades. Focus on your mechanics, and you will be tested. So just make sure that you're emotionally ready to handle some of those moves that it can make. So zooming into our time frame here, let's go through some detail of what we did. I think this is fascinating in the fact that rolling and adjusting and how it can aid in your trading and your position. So here was our opening day. It had made a pretty big move up from its earnings announcements, but earnings was over. The problem with this entry, just looking at it now, is we had pretty bad IV. It was still, I guess, elevated. It was close to 50. The problem, it wasn't through the roof, which is the problem with the trade. And you can see that when we opened the trade, we had 41 rank, and we'll get down to when we closed the trade. The IV rank was actually higher at the time we closed the trade. So keep that in mind when you're doing these. And it's a good lesson. You do need to focus on IVR, but at the same time, you do need to continuously trade. So keep that in mind. The higher the IV, though, the tighter you want to make your position. So you want to be focused on 20 delta strikes for your strangles, or I mean, you want to, if you're really aggressive, you want to trade straddles during that time. And if the IV rank is lower, you want to take it a little bit wider. And that's kind of how the back testing plays out. So here's our entry day, this yellow candle here. And so that's when we opened the iron condor. And so what we did, we ended up trading the 410, which is up here. So we sold the 410 call and bought the 415 call. Obviously, these lines aren't exact because I'm at the 425, but you get the picture. And then we sold the 305 put down here, and we bought the 300. So again, not perfect, but it gives you an idea of what we're doing. Iron condors are always a little harder to draw on because there's 4 strikes instead of just 2 with the strangle. Anyway, on this day here, which was 8/17, we moved our calls down. So the position went right against us pretty hard, and then we didn't do anything on this spike here because it was so early in the cycle. We waited and waited and waited. It actually came back to where it was, so we're like, oh, perfect, but then it sold off pretty hard. So it sold into our short strikes, and so in that case, we moved our call side down. And so we took the 410, 415, and moved it down to 380, 375, excuse me. So we closed this out. We sold the 375 and the 380, bought the 380. So this is short, this is long, and this is again our call side. So essentially what we're doing is we're locking in the gain here. We're like, all right, we made some money here. Let's take the gain and move this side down. What this does is allows us to take in more premium. So on the initial trade, we took in $1.50. Now we've added another 38 cents to the trade. So that means 38 cents further out on this side, our break even goes. Okay. The very next day, it actually gapped down and opened way below even our long strike. And so what we ended up doing the next day, which actually was after the weekend, which was a Monday, we moved the calls down again. So we ended up taking them down from the 375, 380 to the 340, 345. So we closed these out, locked in the gain, and we took in just under this 350 handle here. We'll just draw it right there. So here's our minus, here's our plus, here's our short and our long. And again, we're on the call side. We've locked in the gain on these, and we take in another 67 cents. So the reason that we could only take in 38 cents here, you can see the power of IV and how it expands the extrinsic value of the contracts. On this roll, the very next day, actually the very next trading day, so on a Monday, we took in almost double, 67 cents. And the reason why is because of this right here. See how IV's come up to, I think it actually hit 100 again that day. That's the reason why we were able to get so much more. So what we're doing is we're rolling into a higher IV environment. We're collecting more and more credits, which you'll see is going to be to our benefit. Okay. Next up is our first roll. So on 8/31, remember, here's our position, this call and this put spread. There's our position. So it's actually doing okay. However, we're not profitable in the position yet. Just because that's the way it was working out at the time. So we picked up the entire position and we rolled it from September to October. And that allowed us to collect another 94 cents in premium. So we'll add all these up again, but this is just continuing to push out our break evens. And that's what occurred here. So we have the exact same position, which ended up being the 340, 345 on the call side. And then the put side hasn't changed. It's still that 305, 300. Market continues to move against us. So this is 9.5 here. And this is our adjustment number 3. We then took our 340, 345 call spread, since it's continuing to move lower, locked in the gain there, and sold it lower at, taking a look at my notes here, 320, 325. So that's going to be this handle here. Okay, so we still have this position, and now this is our call position. So we short that, and we long that to make the spread, and this again is our call side. So now we're almost to a place where we are at almost a straddle, but not quite yet. So the reason that we're going to potentially here get to a straddle pretty quick is that's the farthest I typically go when you're talking about a defined risk trade. So that means your short call and your short put are at the same strike. And so we gave it some nice duration here. It gapped against us. We actually were trading other positions on the long side here. We made some money on those, but we still maintain this position. Remember, this is up at the 320, 325, 305, 300 on the put side. So it's kind of moving down. It moves back into our range. It's trading around this 300 handle. And then the news comes out that the SEC is going after Elon Musk. And so the stock gaps down and gaps way down. And so what we did here was we actually created our straddle. So this became closed, and then we still the 305 calls. So it's 305 calls, and then bought the 310s. So now what we have is we have a 310 call on top. That's our long. We have a 305. That's our short call. So this is our call side. This is long, and this is short. And then on the put side, we have 305, and we have 300. So when I say straddle, it's actually an iron butterfly. It means we have a defined risk iron straddle on the trade. Okay, so this is our minus put, and this is our long put. So really what we want the stock to do is basically hang out around the 305. But the thing is that we've now collected almost $5 on each side. So our break evens are going to be up to 310, which is about our long call, and down to 305 or 300, which is our long put. So we've got a $10 pretty much range for the stock. And I mean, it's a high flyer, so don't expect that we're going to actually pin it there, but we ended up doing that, which was great. So you see how this spiked up here in IV? That allowed us to collect more premium when we did this. So that allowed us to collect another 74 cents. So in total, if you add all these up, and they're all on the web page, each trade and each credit, we have now collected $5.14 in credit. Over the weekend, Elon Musk settles with the SEC. The stock gaps up to exactly where it was before the gap down. That opportunity there, along with the gap up crushed IV down under 75, that allowed us the very next day to take off the trade for $4.87. You can't plan these things, but when you take your time and you're patient, you're mechanical, they typically come back into the range that you wanted them to. And the fact that you're collecting credits along the way means it's no harm, no foul. This trade doesn't cost a lot to put on since it's defined. It's like $400 or $500. You could hold that out for as long as you needed to, as long as you continue collecting premium on the rolls. So that's how we ended up getting out of the trade for a profit, a small profit. I mean, we pretty much paid for our commissions, but that's better than taking the loss, right? So in table form here, we opened the position with an IV rank of 41. And then if we go down to the bottom, you can see the IV rank moved up to 64 when we closed the trade. But we closed it out for 487. So if you were doing 6 contracts all along, it would have been over $100 profit. But the thing is, you would have been paying quite a few commissions along the way. So maybe you were break even on the trade. But again, it's a win for us as long as we're able to roll and maintain credits along the way. So you can see every single time we're collecting premium. $1.50, another 38 cents, another 67 cents, another 94 cents, 51 cents, 40 cents, 74 cents. And so the way that you calculate your profit or loss at the end is you add up all those credits and subtract away the debit that you paid to get out of the position. So really solid case study there. Happy with the trade. But let's go up to our big winner for the year, actually. Our biggest winner of the year is going to be a strangle here in Tsla. So we'll go over to the charts and clear out all of our drawings and kind of start over here. So we actually opened the trade much, much later when the IV environment was very, very high on 9/18. So that's this day here. This day right here. We'll throw an arrow in there. We made an adjustment on 9/26, which is here. Stock's moving a little bit higher, and then 9/28, which was down here. And then we closed the trade on 10/4 before it actually fell off a cliff. So what we did on this day here was sell the 350 all the way up to the 350. Oops, sorry about that. You can see, even though this is super wide, $50 wide, this stock moves like crazy. So be prepared. Let's actually, I'm going to center this up since now we're a little further along here. So we are in the 350. This is our short call strike. And then we're down to the 220 on the put side, somewhere down here. Nice wide range. IV through the roof when we enter this thing in. I think we're at like 93 or something up here. Perfect trade. It did nothing, exactly what we wanted to do. So premiums just started coming out of this thing as IV kind of headed lower. IV continued to head lower. The stock was starting to move up towards our 350s. And so just to collect a little more premium, we took the 220s and we didn't go to 250. We just went to 230. I mean, we just inched it up, right? So we're just collecting a little bit more premium, only $1, but it's going to come in into basically how much we make on the trade at the end. So what we don't know is that the stock's going to gap down, 30, 40 bucks, but that's nothing we can do about that. So we just have to trade what the market gives us. So on 928, when this gap down occurred, we didn't go crazy. We didn't move him all the way down to the exact same, strikes, the at the money strikes. All we did was move him down to 350, to 340. So all we've done is kind of narrowed down our range a little bit. Not a big deal. Continue to collect premium. So on the initial trade, we collected $14.16. On the first put move up, we collected another $1. And on the call move down, we collected another $1.19. So we got $16.37 in this trade. Huge premium. All we're looking now is for the stock to close within those ranges that we've defined, or IV to kind of get sucked out of it, which actually did end up happening. So you can see as IV kind of moved lower here. Obviously, I did not like the close here, and the fact that we've had these couple down days, which ended up being a good play, I guess, just by seeing these things in the past. I went ahead and closed out the position. It would still be fine because remember our puts are down here at 230, but it's continuing to inch closer, and the fact that IV really came in probably escalated the price of those contracts, which wouldn't allow us to get out where we did. So good move on our end, getting out when we needed to get out. And so 92 ranked to start. Here's each trade that we just talked through, and we closed out for $9.32. So just a one contract position of that would cost you about $2,800 to hold it, and you made $705 on that $2,800. If you think about it, if you were to buy stock, and this is kind of a good example of why stock is so inefficient. If I was to buy, when I open this trade, let's say at 300 or 295, since that's in our range. If I wanted to buy 100 shares, it would have cost me $29,000. $29,000 to be able to hold a position. And immediately, if I would have shorted the shares on that day, because it was a decently strong red candle, just knowing that it was going to go down, I would have just immediately started losing money as the stock went up. Of course, I would have made a ton of money on the gap down and lost it all on the gap back up. The fact that you can create these ranges all the way up to 350 and all the way down to 220, and then also adjust as the stock moves, it's a no-brainer why we don't use stock. We use options, and we're strategic in the way that we create ranges and directions if we need to. It's much more capital efficient. You can adjust as you go. As the market moves, you can just ebb and flow with it. And, you can create a winning record, and you can create kind of the portfolio that you want to have and the returns that you want to have. You can calculate all that out. And as long as you're being consistent, you're trading small, you're continuing to take on premium, even in times of low implied volatility, but especially in times of high volatility, you're gonna be successful at this game. It's not an overnight. It's not a double your money in a week. It's not binary options. It's none of that. It's tried and true, research-driven strategies that help you maintain your portfolio and your money. Our entire goal is to help you manage your own money, quit paying fees, quit settling for 10, 15% returns. You should be targeting 30 to 40% returns on your money a year. And that's what we're here to do. We're here to help you try to figure that out. And we're going to try to do as much as we can of that for free. But of course, we're trying to run a business here, so we want you to get you the tools that you need to be able to fish. We don't want you to have to pay for alerts or pay for education when all of that should be free. We want you guys to get out there, get in the markets, trade, get used to it. And then if you need some additional help, sign up for our trade alerts. When we trade, you can get that alert. You can make the trade or not. It can be a learning opportunity. You can kind of sit back and say, all right, I'm going to mark my chart here. This is where they got in. What happened? Did they lose on the trade and then win on the trade? It becomes almost an invaluable piece of information that helps you make decisions in the future when you're doing this alone. We want you to be mechanical. We want you to learn to make money and learn to manage your own money. So with that, we'll close it up. Hope you guys have a fantastic second week of October. We are really excited for the second end of this next week and then the following week as earnings are really going to start coming into play. We hope to probably be making 2 to 3 earnings trades a day. So if you guys are excited about that, make sure you follow us on Instagram. We'll be posting stories and pics and posts about the earnings trades that we're making. And then hopefully in our next earnings cycles after the new year, we'll have our alerts live so you can get those alerts right away. But have a great week. If you have any questions, let us know. We're here to help.